Hey everyone, welcome to the channel. Before I started investing, I thought it was only for rich people or financial experts. But I quickly learned that investing is for everyone, even if you're just starting out or don't have a ton of cash. Investing isn't just for Wall Street, it's your personal roadmap to grow wealth, beat inflation, and reach your dreams faster. A lot of people think investing is too risky or complicated, but with the right strategies, it can be simple and rewarding. In this video, we'll break down 5 beginner-friendly investment strategies, explain the pros and cons, and walk through real-world examples. You'll learn how to pick what fits your goals, risk tolerance, and lifestyle. Smash that like button, and let's dive in. First up, buy and hold, the classic long-term strategy that's helped countless investors build wealth. You buy quality stocks or ETFs and hold them for years, ignoring short-term market swings. For example, investors who bought shares of companies like Apple or index funds like the S&P 500 ETF decades ago have seen their investments multiply over time. Think of it like planting a tree. Give it time, and it grows. Historically, the stock market has recovered from crashes and downturns, rewarding patient investors. Warren Buffett's favorite approach, it's low maintenance and relies on patience, not market timing. Buffett famously held Coca-Cola and American Express for decades, letting compounding do the work. The hardest part? Staying calm during downturns. Our brains are wired to avoid loss, so it's tempting to sell when markets drop. But history shows that those who hold on often recover and profit. To choose quality stocks or ETFs, look for companies with strong financials, consistent earnings, and a history of weathering tough times. Diversify your holdings to reduce risk. Remember, slow and steady wins the race. Buy and hold isn't flashy, but over decades, it's proven to be one of the most reliable paths to financial growth, especially for those who can tune out the noise and trust the process. Next, dividend investing. Earning passive income just for owning certain stocks. Companies share profits with you as dividends, often quarterly. But before investing, it's important to evaluate dividend stocks carefully. Look at the dividend yield, but also check the payout ratio. The percentage of earnings paid as dividends. A healthy payout ratio, usually between 40% and 60%, suggests the company can sustain its payments. Blue-chip companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, PepsiCo, and 3M are classic dividend aristocrats, firms with decades of rising payouts. Setting up a DRIP, dividend reinvestment plan, lets you automatically reinvest dividends to buy more shares, compounding your returns over time. Remember, dividends are often taxed, so consider the impact on your returns, especially if investing in a taxable account. Many successful investors have built wealth through dividend investing. For example, John D. Rockefeller famously said he found receiving dividends to be one of life's greatest pleasures. Modern-day investors like Geraldine Weiss, known as the Grande Dame of Dividends, and Tom Connolly, who runs the Connolly Report in Canada, have championed this strategy for decades. This approach is great for those seeking regular income and stability, especially near retirement. You trade explosive growth for steady cash flow and peace of mind. Now, growth investing. Chasing companies with rapid revenue and earnings growth. But how do you spot a true growth company? Look for businesses driving innovation, those launching new products, disrupting industries, or rapidly expanding their market share. Think of Jeff Bezos with Amazon, or Cathie Wood's ARK, invest-backing companies like Tesla and Roku, visionaries who identified transformative growth early and reaped the rewards. But beware the risks of hype. Not every fast-growing company is a winner. Take WeWork and Theranos. Both promised the world but ultimately collapsed under scrutiny. Growth stocks can skyrocket, but they're volatile and risky. Prices often swing wildly on news, rumors, or missed expectations. To manage risk, dig into financials, check for consistent revenue growth, strong leadership, and a clear path to profitability. Don't just follow the crowd. Remember, you're betting on future potential, not current profits. It takes vision and caution. Growth investing is best for younger investors with time to recover from losses and a high-risk tolerance. High risk, high reward. Do your homework, diversify your bets, and buckle up for the ride. Value investing is about finding quality stocks on sale. But how do you know if a stock is truly a bargain? You look for solid companies the market has undervalued. Think bargain hunting. The trick is to separate real deals from markdowns that aren't worth it. Start by analyzing financial statements. Focus on the balance sheet, income statement, and cash flow. Look for strong earnings, manageable debt, and healthy cash reserves. Key ratios like PE, PB, and debt to equity help you spot value. Patience is key. You might wait years for the market to catch up. Legendary value investors like Seth Klarman, Joel Greenblatt, and Monish Pabrai have waited for the right opportunities, sometimes holding cash until a true bargain appeared. Benjamin Graham, the father of value investing, called this a margin of safety, buying well below intrinsic value to protect yourself from mistakes or market swings. Value investing is for analytical investors who enjoy research and can go against the crowd. Investors like Jean-Marie Evelard and Bruce Berkowitz have made fortunes by sticking to their analysis, even when others disagreed. Sometimes you find a gem, sometimes a dud, so dig deep. Use practical screening. Filter for low PE or PB ratios, strong free cash flow, and consistent dividends. Watch out for value traps, companies that look cheap but have declining businesses or hidden risks. For example, David Einhorn's investment in Green Mountain Coffee Roasters showed how deep research can uncover both opportunities and risks. Spot undervalued sectors by comparing industry averages and looking for areas the market has overlooked. Sometimes entire sectors are out of favor, offering opportunities for those willing to do the homework, like when Michael Berry identified value in the housing market before the 2008 crisis. And always avoid value traps. Don't just buy because something is cheap. Make sure the company's fundamentals are solid and the business has a future. Don't want to pick individual stocks? Index funds and ETFs might be your answer. Both let you invest in a wide range of companies at once, but there are differences. Index funds are mutual funds that track a specific market index, while ETFs or exchange-traded funds trade like stocks throughout the day. With either, you can buy a basket of stocks like the S&P 500 in one move for instant diversification. Pay attention to expense ratios, the annual fees charged by funds. Lower expense ratios mean more of your money stays invested. Many index funds and ETFs have very low fees, sometimes as little as 0.03%. To build a diversified portfolio, consider mixing U.S. stock funds, international funds, and bond funds. This spreads your risk and can smooth out returns over time. It's like getting a sample box at a bakery, different flavors, all in one package. Passive investing with index funds or ETFs aims to match the market's average return. Historically around 10% per year for the S&P 500. The pros? Low cost, low stress, and less time spent researching. The cons? You won't beat the market, and you're exposed to market downturns. Automation tools let you set up recurring investments, so you can invest consistently without thinking about it. This approach is recommended by well-known investors and institutions, like Jack Bogle, founder of Vanguard, and large pension funds such as CalPERS, who favor low-cost, diversified index investing for long-term growth. For beginners, index and ETF investing offers simplicity, steady growth, and a smart way to build wealth over time. You've just learned 5 strategies that can fit any personality or goal, just like Maya, who started investing with her first paycheck, or Carlos, who built his portfolio one small step at a time. Remember, you can mix and match approaches, just like Priya, who combined index funds and real estate to fit her needs. Before you dive in, set clear, realistic goals for your investments. Think of Sam, who wrote down his dream of buying a home and tracked every step. Track your progress regularly. Review your portfolio, celebrate small wins, and adjust your plan as you learn, just like Aisha, who checks in monthly and celebrates each milestone. Start small, stay consistent, and let compounding work its magic. Remember, every investor's journey begins with a single step. Avoid common beginner mistakes, don't chase quick profits, don't invest money you can't afford to lose, and never stop learning, just like Lee, who learned from early setbacks and kept going. The best strategy is the one you understand and can stick with long-term. Just ask anyone who stayed the course and seen their efforts pay off. Stay motivated. Every step forward is progress and every mistake is a lesson. Your story could inspire someone else. Join our community, like, subscribe, and share your goals or questions in the comments. Let's learn and grow together.